Hello everyone, welcome to lesson 2 of module 1. We are talking today about mortgage pre-approval, just trying to figure out, okay, what does the process entail? My name is Dr. Kevin Shuford, the property professor. I am a real estate agent and mortgage lender in Arizona and California with referrals across all 50 states and internationally. I will be your guide here. Let's go ahead and jump into this about mortgage pre-approval. So the first step in purchasing a home is figuring out how much mortgage you can afford, how much house you can actually afford. This is going to be very important because it's going to set your budget and let you know what that mortgage payment is going to look like every single month. When thinking about what sellers prefer to have offers that are actually pre-approved and backed by a lender. If you submit an offer without a pre-approval or pre-qualification, then it's not going to be as strong as if you submitted one that had one. This is also going to help you save time and stress later on in the process because getting an offer accepted then scrambling to find financing can be very stressful. Sometimes there's situations where during the middle of the process you actually switch lenders, and that is okay, it happens, but not having to worry about it after you've already started the process gives you a little bit of peace of mind. So let's dive further into this and talk about what lenders are actually looking for. So mortgage lenders are going to be looking for 4 key factors. First, they're going to be looking at your income. So how much money are you pulling in at your job? They're going to be asking you for your pay stubs. If you're buying with somebody else, then they're also going to want to see those pay stubs just to see how much money you're actually pulling in every single month. Next is credit score. And so credit score is going to vary depending on loan programs. You can qualify for mortgages if you have a credit score in the 500 range, but it's probably going to be a little more difficult to qualify and your loan is going to be more expensive. Ideally, we want to be in the 620 and above range. If you can be in the 700s, the 800s, that is excellent. You're going to get a better rate overall, which means a better price as well. And then third thing they're going to be looking for is your assets or your savings. How much money do you have in reserves to potentially cover some of the costs you're going to be incurring, like the down payment, earnest deposit, closing costs. They want to see, okay, how much money do you have in every other place, your bank accounts, your stocks, etc., just to see what that looks like. And then finally is the debt to income ratio. So we're going to dive into this a little bit further on the next slide because I think that's worth explaining a little bit more. So your debt to income ratio is one of the biggest factors in determining your pre-approval. And so we take a formula here that is you're going to divide your monthly debts by your monthly income. So for example, if you're making $8,000 a month and you have debts of $3,200 per month, so in things like your rent, these are recurring debts. So rent, car payment, maybe credit card payments, then your DTI would be 40%. Most lenders are going to want to see under 36%, but depending on the loan type and loan program and the specific buyer situation, that percentage can get a little bit higher into the 40s even if you're actually going to be able to make it work and there's other factors that are at play there. So if you can keep your DTI under 40%, under 36% ideally, then you're going to get a better rate overall and just a lower payment. If though you have a higher debt to income ratio, then unfortunately it's going to be much harder for you to actually qualify for a mortgage. And so you might have to, in some situations, maybe pay something off beforehand to get rid of that debt completely to then be able to actually qualify for the mortgage. There are some common myths surrounding a pre-approval, and so I just want to dispel some of those right now. One of the first ones is that people oftentimes think that if I get a credit check for this pre-approval process, then it's going to destroy my credit score. And that is actually not true. So what lenders typically do is they will do a soft pull on the credit just to get a snapshot of what it looks like right now during that pre-approval, pre-qualification process to find out how much home you can actually afford. If you decide to move forward with the purchase of a home and you're in that under contract on a house, then that is when they will actually do a hard pull on your credit to make sure that everything actually does check out. And even if you do get dinged for this, if you don't have a lot of other credit checks in your recent history, then this score drop, if it drops at all, is going to be probably fairly slight. The next myth that really drives me crazy is that buyers often will think that they need 20% down in order to make a purchase on a house. So if you're buying a $500,000 house, that's going to cost you $100,000 to actually purchase it. And that is not true. There are many different types of loan products and programs that are out there that allow you to purchase for much less out of pocket than that. So for example, with a conventional loan, you can get into a house for as low as 3% down or 5% down. So that's looking at either $15,000 or $25,000 on that $500,000 purchase. You can also go potentially an FHA loan, which is going to give you the option of doing a 3.5% down payment. So that's about $17,500 on that $500,000 home. And then even some VA programs and USDA programs can actually get you into a house without actually putting any money down out of pocket. And so you do have options here, but you need to explore them and figure out with your lender which program is going to be the best fit for you. And then finally, the last myth here is that all of your debt must be paid off before you actually apply. That is not true. Really what we want to see is just, is your debt to income ratio workable? Can we make it so that you can afford to actually buy this house? Or is this house purchase going to put you over the top to where you are feeling like you're underwater? And so if you can pay off some debts beforehand, then that can be a good thing and help you be qualified for a higher sales price on a home. But you also have to be careful too, because sometimes paying off certain things on your credit can actually cause your score to drop. So that's a whole nother conversation. If you want to know more about that, go ahead and reach out to me and I can give you more information. So I was working with a couple who had some student loans and they thought that they could not afford to purchase a house because they had those. Well, what they found out through conversation was that the student loan does not actually charge necessarily against you at the same rate as other debts, like car loans, for example, or credit card debt. And so we had a conversation. We found out that, okay, you have some money coming in right now. You could pay a chunk down on some of these other loans that you have to improve your credit overall, to improve your debt to income ratio. And because of that, they were then able to qualify for a higher purchase price on a home. And so this pre-approval really is about strategy. It's not about being perfect. We need to have the conversation to figure out, okay, what is going to work for you specifically, because no one's situation is exactly identical to somebody else's. So this has just been a quick overview of what lenders are looking for. We're going to dive further into what your specifics look like in terms of loan types and programs in the next lesson. But just as a reminder here, your pre-approval is that ticket to board the plane. It's the way to get the process fully started. Lenders are going to be looking at things like your income, your debt to income ratio, and your credit score. All of those are going to factor in to see how much home you can afford and what your mortgage rate is going to be and what your mortgage payment will ultimately be as well. And then I hope that I've dispelled some of these myths that we mentioned on the last couple slides to make sure that you feel more comfortable knowing that you don't have to have 20% down in order to purchase. You don't have to pay off all of your debts either. You actually can get pre-approved for a mortgage and not take a ding to your credit. And so hopefully this lesson has been helpful for you overall. So that is going to conclude lesson 2 on what lenders look for. But in lesson 3, I think it is a very important one because we're going to be covering closing costs. So how much money do you really need, and how can you use credits to your advantage to make sure that you pay as little in closing costs, if nothing at all, if possible. And so this next lesson, lesson 3, is going to be very important and will be the way to round out module 1 overall in this overview of the home buying process. I hope to see you there. Very quickly before you go, I just want to say that I appreciate you sticking around watching this video. I highly encourage you to subscribe to the full Real Estate and Mortgage 101 series because I have a lot more lessons coming out for you to make sure that you feel as confident as possible in the home buying process. I also highly encourage you to download the full Module 1, which you can do by just clicking on the link in the description box down below. There's also a lot of other resources in there that I think are going to be very beneficial for you. I know this process can feel overwhelming, so I appreciate you sticking here, and I'm here to help you every step of the way. If you need to get in contact with me, feel free to give me a call or shoot me a text message or an email at the number and email that you are seeing on the screen. As I mentioned, I am a loan officer and a real estate agent in Arizona and California, where I do business myself specifically, but I also serve clients across all 50 states and internationally with some very strong referral partners. So if you need me, if you have questions, if you want to work with me, please feel free to reach out and I will do my best to take care of you. I'll see you on the next one.